The Banking Royal Commission is on, housing credit is still growing strongly, and home prices in Sydney are slipping. So plenty to discuss in this week's Property Imperative Weekly to the 2nd of December 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's review of finance and property news, we start with the announced $75 million Royal Commission into financial services, which, after lots of wrangling, was announced this week. I'll leave the politics alone, but as Fitch Ratings said, the inquiry into alleged misconduct as challenges to the financial system, and the findings could weaken the reputation of individual players or possibly expose wider structural weaknesses. So we think uncertainty about whether there will be an inquiry and what scope it would cover has been replaced by potential uncertainty of outcome. Okay, the scope has been crafted to include a wide gamut of players from banks, insurers and superannuation funds, but it is narrow because it only looks at misconduct against community expectations. It will touch on culture and governance, and this poses the question of the relationship between misconduct and culture. And it is also tasked to make recommendations to fix things, but steering around other parallel work, including the vertical integration, which the Productivity Commission is looking at, and ACCC's work on pricing. So it would likely focus on the well-trod paths of poor financial advice, bad insurance policy outcomes, and inappropriate handling of SMEs when they get into financial difficulty. We hope that the inquiry will specifically look at the various conflicts of interest which currently exist across the sector. Credit and lending policies appear to be in scope, but we will have to wait and see whether they are explored, along with the role of financial advisors and mortgage brokers. The scope does not touch on broader policy or regulatory issues, such as macroprudential, but it could conceivably cover lending standards and liar loans. One potential outcome could therefore be to lift the lid on the not unsuitable lending. The Commission will not consider the disruptive intrusion from digital or fintech. What we can say is that the banks and the government clearly decided to cut their losses in the light of the potentially broader and more detailed scope which was being discussed on the backbenches. This way, they are controlling the agenda, at least to some extent. An interim report is expected next September. Lots of economic news came out this week. The ABS dwelling approvals for October were stronger than expected, reaching more than 19,000, the highest since August 2016. Growth in Victoria drove the approvals higher, which was up 3.8% there, whilst there was a fall in New South Wales, down 0.3%. We are still seeing the strongest demand for property in Victoria, thanks to strong migration, though supply and demand is patchy, as the recent ANU study highlighted. Overall, this suggests more property will continue to come on the market for some time ahead, putting further downward pressure on prices. The RBA's credit data for October showed that lending for housing rose 0.5% in the month and 6.5% for the past year, which is 3 times inflation. Lending to business rose at 0.3% to 4% over the past year, and personal credit was flat in the month and fell 0.9% over the past year. Another 1.2 billion of housing loans was reclassified in the month, making 60 billion in total, and that's more than 10% now of all investment loans on book. The proportion of investor loans fell slightly, down to 34.2%. Total mortgage lending is now above 1.7 trillion, with owner-occupied loans up 0.6% or 6.6 billion to 1.12 trillion, and investor loans up 0.2% or 1.2 billion to 584 billion. Comparing this with the APRA data, we see continued relative growth in the non-bank sector. The parallel ADI data from APRA to the end of October 2017 shows that banks continue to lend strongly to households. The overall value of their mortgage portfolios grew 0.5% in the month to 1.57 trillion, up 7.3 billion. Owner-occupied loans grew 0.6% to 1.03 trillion, up 6.4 billion, and investor loans rose 0.15% to 816 million. The proportion of investment loans continued to drift lower, but it is still at 34.8% of all lending, and that's still too high in our view. CBA reduced their investment portfolio this month, whilst Westpac grew theirs. Investor lending market growth is sitting at around 3% over the past year, though some smaller lenders are well above the APRA 10% speed limit. There is really simply no excuse to allow home lending to be running at more than 3 times inflation or wage growth at the current dizzy prices and leverage levels. There is still too much focus on home lending and not enough on productive, growth-enabling business lending. This is something which the Royal Commission is unlikely to touch, as it is a policy, not a behavioural issue. The OECD report on Australia said that things are looking better. As a result, they recommended rate hikes next year to help cool the housing market, but they called out a number of risks to economic growth and said macroprudential measures should be maintained. Also, their growth rates are lower than the latest from the RBA. They said that Australia is vulnerable to too big to fail risks due to its highly concentrated banking sector. The Reserve Bank in New Zealand has been more proactive on managing risks in the housing sector. They announced a slight reduction to tight loan-to-value lending controls in response to slowing housing in New Zealand and new government policies there. The loan-to-value ratio policy was first introduced in October 2013, with progressively tighter restrictions for investors introduced in November 2015 and October 2016. So from the 1st of January 2018, the LVR restrictions will be adjusted so that not more than 15%, currently 10%, of each bank's new mortgage lending to owner-occupiers can be at LVRs of more than 80%, and no more than 5% of each bank's new mortgage lending to residential property investors can be at LVRs of more than 65%, currently at 60%. They had previously parked their loan to income initiative in the light of easing momentum. The Grattan Institute published a report which showed rising housing costs are hurting low-income Australians the most. Those at the bottom end of the income spectrum are much less likely to own their own home than in the past, and are often spending more of their income on rent and are more likely to be living a long way from where most jobs are being created. In 1981, home ownership rates were pretty similar among 25 to 34-year-olds, no matter what their income. Since then, home ownership rates for the poorest 20% have fallen from 63% to 23%. Home ownership rates also declined more for poorer households among older age groups. Home ownership now depends on income much more than in the past. They say that reducing demand, such as cutting the capital gains tax discount and abolishing negative gearing, would reduce prices a little. But in the long term, boosting the supply of housing will have the biggest impact on affordability. To achieve this, they say state governments need to change planning rules to allow more housing to be built in inner and middle ring suburbs. So now to home prices. According to ME Bank, in a study of 1,500 Australian adults, 43% of respondents said they were reliant on future home prices to achieve future life and financial goals, with 10% completely reliant. But it's a tug of war as which way we want prices to go. 38% want prices to increase, while 37% want them to fall. Where you sit largely comes down to your property ownership status. 39% of those who own the home they live in and 47% of those who own an investment property indicated they were reliant on future price growth, whilst 48% of those who don't own a property also said they were reliant on prices falling. Most tellingly, the survey indicates more Australians would benefit from property prices falling than rising, with only 28% indicating they'd benefit by selling if prices continue to rise, compared with 47% who said they'd benefit by buying if property prices fell. But then again, according to CanStar, nearly 4 out of 5 Australians don't see home prices falling in their state over the next 2 years. CanStar surveyed just over 2,000 consumers on their views on property prices and home buying. Nationally, 47% of respondents expected steady growth in home prices, with a further 8% predicting prices would skyrocket at some point soon, and just 11% of respondents thought prices could fall in the next 2 years. Sydney was the most pessimistic city, with 16% predicting values would fall. Now compare this with CoreLogic's Home Price Index, which reported a 0.1% fall nationally in November, and Sydney recording a 0.7% fall, along with falls across Darwin and the Northern Territory, down 0.4% over the month. For the remaining broad regions of Australia, dwelling values were relatively steady, or experienced a small rise over the month. However, the averages hide significant variations, with, for example, more expensive homes sliding further relative to cheaper ones. National dwelling values tracked 0.2% higher over the past 3 months and have increased by 5.2% over the 12 months ending November. The national average growth rate has now halved since reaching a recent peak in May 2017, when dwelling values rose 10.4%. CoreLogic also said that there were 3,409 homes taken to auction across the combined capital cities last week, and returning a preliminary auction clearance rate of 66.9%, which overtakes the previous week as the third busiest for auctions so far this year. Last week, based on the final result, 60.9% of the 3,390 auctions held recorded a successful result, and that's the lowest clearance rate since late 2015, early 2016. But auction clearance rates may be lower than the CoreLogic figures suggest, according to John Cunningham, president of the REI-NSW. Cunningham said that 40% of results had not been reported, and if these results represented a no sale, then the clearance rate for Sydney could be a lot lower than the 66% being reported by CoreLogic. The problem is the lack of clear data from the 40% of unreported results, and that means we don't necessarily get a real picture of the market, he said. More evidence of tighter lending standards this week, with CBA revealing a raft of changes including LVR caps and restrictions to rental income for serviceability that will impact mortgage brokers and their clients from next week. CBA will be introducing a new home loan written assessment document called the Credit Assessment Summary, or CAS, for all owner-occupied and investment home loan and line of credit applications, solely involving personal borrowers. Meanwhile, CBA confirmed it will also introduce credit policy changes for certain property types in selected postcodes from Monday the 4th of December. They will reduce the maximum LVR without lender's mortgage insurance from 80% to 70%, reducing the amount of rental income and negative gearing eligible for servicing, and charging eligibility for LMI waivers, including all professional packages and LMI offers from customers financing security types in some postcodes. But they said, we will continue to lend to all postcodes across Australia. More rate cuts were announced this week, with Heritage Bank, for example, cutting the rate on new owner-occupied loans by up to 50 basis points and by 30 basis points on new investment loans. They said they wanted to build and keep attracting new customers to the bank as part of their nationwide growth strategy, but this will put more pressure on their margins. And talking of margins, KPMG released their 2017 Mutuals Industry Review. Under the hood, the sector is under pressure, despite asset growth. COBA said that they welcomed the backing from KPMG, which highlighted strong financial performance, but we are not so sure. Yes, assets are growing, but at what cost? KPMG says profits before tax declined across the sector by 4.3% to $605 million. This compares to the major banks, which saw profits grow by 7.6%. The net interest margin continued to tighten and decreased by 11 basis points to 2.03%. The increasing pressures on net interest margin is a result of historically low interest rates and increasing competition in the marketplace. Mutuals have sacrificed margin to maintain and grow their membership. The average capital adequacy ratio also dropped by 30 basis points to 17.2% in 2017, representing a decline in capital levels for the fourth consecutive year, but still well above targets. This reflects the increasing prioritisation of effective capital use by mutuals, as limited equity funding is inherent within the mutual's current business models, and capital growth through new profits has been constrained this year. Mutuals have looked to existing capital bases to fund their balance sheet growth. We think the Royal Commission will tend to drive international funding costs higher. They were actually already going up. And as banks have around 30% of their books funded offshore, this will put more pressure on margins and local mortgage rates. In addition, we're still forecasting a cash rate hike next year, so more pressure on mortgage rates from there too. At the same time, lending standards continue to be tightened, so borrowers will need a larger deposit, especially in some higher risk areas. Mortgages are set to become more expensive and harder to get. Also, more new property is set to come into the market. And as home price momentum eases, this will tend to push prices lower. So we can suggest several reasons why prices will go lower, but none to make them rise. So on that basis, the 80% of households expecting prices to keep rising are in for a rude awakening. And that's the Property Imperative Weekly to the 2nd of December 2017. If you found this useful, do leave a comment or subscribe to receive future updates. Check back next week for our latest update, which would include November mortgage stress results. Many thanks for taking the time to watch.